Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Scott Choppin. Thanks for being on the show, Scott.
Hey, Whitney, great to be here. Appreciate the invite.
I'm happy to have you on the show. And before I tell you about Scott, I want to remind you to go to the Facebook group, the Real Estate Syndication Show, where you're going to learn from experts just like Scott. You can ask your questions in there, questions you want me to ask guests on the show. And I encourage you to go there and join. Also go to Life Bridge Capital, where you can sign up on the Contact Us page, and I will reach out to you personally. So about Scott Choppin, he's a real estate developer of highly undersupplied multigenerational urban housing for families. He's going to tell us in a minute what that is, what that means, but producing investor opportunities and long-term hold new construction investments in high-demand urban metros. Married for 26 years to Becky, raising 3 kids. Scott, that's incredible. That's an accomplishment in itself.
Well, I appreciate that, Whitney. Like we talked about earlier, my family's my greatest accomplishment. So.
Yeah, I was telling Scott that not everybody puts something about their family in their bio, and I appreciate that. That's awesome. Well, thank you again, Scott, for your time, and give us a little more about your background, how you got into this new development, asset class, and have you always done that, and and how you got there a little bit, and then let's dive into what you do exactly.
Absolutely. Yeah. So I have been in basically real estate development my entire life. My family started developing real estate in Long Beach in Southern California in 1960. So we're, 50 plus years in the business of real estate development. And what I mean when I say that is we are purchasing land assets and building buildings on them to produce income over either, a long-term hold, or sometimes we merchant build and, sell them at the end of the absorption period. But in it, development is taking land assets, changing them in the way that's appropriate to be able to build the asset that you want and to produce value when it's completed.
Nice. Okay. So, in your bio, you said you're a real estate developer of highly undersupplied, multi-generational urban housing. What does that mean exactly?
So we have always, as a company, so I formed Urban Pacific Group in 2000. So we're going on our 19th year of operations as a pure play real estate development company. We've done different asset types, so new construction, condo, market rate apartments, and also we've done numerous affordable housing projects throughout our life cycle of our company. But we've always focused on urban infill is the term that we use, and what that means is that we're working within existing metro urban areas. Think of mostly developed, not necessarily downtown. Although we have done projects in downtown, central business district, but we're not suburban either, or even rural. So we're in the existing fabric of the city and looking for assets, land opportunities that we can develop, to infill an already existing neighborhood. And we've always been encouraged by that product type because, it's close to transit, it's close to job centers, and for our tenant, profile in our workforce housing communities, it's also where their social networks are. So kids go to school, their families are close by, their churches are close by. And so we've always been encouraged to find a demographic that is seeking to be in that location. And in 2000, when we started the company, it was, Gen Xers who wanted to live in, cool downtown locations in an urban loft. That was sort of the start of it. And then it's evolved, from there to millennials now are attracted to that product space, but also now what we focused on is existing family groups that are already here in the urban locations and serving them with a new type of housing that facilitates their lifestyle. So we call it workforce housing, moderate income housing, sometimes is how we describe it, but it's very undersupplied. We're in California, which has out of the top 25 most expensive marketplaces in the United States, at least one stat that I saw, 18 of the top 25 were in California, and all the top 10 were in California. So, rents and housing prices versus incomes in California are diverging. And that is a story across many urban metros, but here it's the most, distinct undersupply situation that we observe in the United States. And that's a market that we want to be in. Now, it has a social impact story to it as well, which I've always had that as part of my career, but it's good to be able to, do good by doing well. And we see this space as exactly that.
All right, Scott. So what markets are you in exactly?
So when we started the program, what we call UTH, which stands for Urban Townhouse, that's our specific, branding of the workforce housing model. We started in Southern California, and the bulk of the active projects we have are here. And so what that means is think of central LA County, southern LA County, and northern and central Orange County. So the LA Orange County metro marketplace. But we do have designs to move this UTH workforce housing model into other urban markets. So in California, the expansion into San Diego, the Bay Area, and then we've underwritten projects in locations like Portland, Seattle, and Denver. And this is actually a product that's, both in demand in those locations, again, the urban, affordability story, but also the right mix of, land pricing, existing zone sites available, and build costs, which, is the formula that we have to keep track of, or the major variables to keep track of to make sure we have viable projects. So our long run picture for this is to expand into all those Western urban metro markets.
And so how do you make a deal work in, Orange County? For you all, what are you looking for? And what kind of numbers are you looking for to make something like that work there? Because you said it, I think you mentioned it yourself, and the types of the prices and the low cap rates in a market that you're in. How do you make that work?
Well, this is the beauty of the difference between buying existing value add assets and building new construction. And so, I won't go into detail about what value is. I think your audience is probably, well aware. But for us as a developer, we can go into highly constrained markets and find land assets that we can then develop our own product. So we're basically creating new assets out of whole cloth. Now, we've got a whole lot of, technical issues to deal with that are different than a value add type of environment. But like any real estate developer, we're always searching for new land assets, but we have specific criteria. So one of our criteria is we only buy sites that are zoned. So we don't want to go through governmental entitlements in any discretionary way where city council or planning commissioners can say no. And then we, our UTH product, because it serves working families, really only goes in certain locations. And I don't mean to be saying that it's exclusive, one way or the other. It's more a function of our tenant base. Working families already exist in these blue collar neighborhoods, is the way we describe them. So low and middle income neighborhoods in any city. So whether it's Orange County or LA County, we're looking for those neighborhoods where our tenant base already lives, and we're now providing them a new housing type that they don't otherwise have available. So that's sort of the two big criteria: location that serves the tenant base and is appropriate for the tenant base, correctly priced land, and already zoned.
So why the new development model versus value add?
Good question. So one, fundamentally, we've always been a developer. And although, we have a lot of crossover and overlap with value add investors, and we invest in our own projects, we are not purely an investor per se. And so we are a developer, which means that we just look at it from the standpoint of, our job is to create new projects and new assets. And we certainly own apartments that we've developed ourselves, but we've never been a pure play value add player. Now, having said all that, we like the differentiator between value add and development in this part of the market cycle. So the way I look at it is, you've heard the term, buy below replacement costs. Like that's I think a very common theme that everybody who's in the value add space would love, to have deals that always fit that criteria, except that in this part of the market cycle, which would be when the market cycle is climbing, meaning going up and positive and growing and or towards the peak, then value add existing assets start to become very expensive, which I think everybody in any major urban metro is, has as an issue. Returns are being eroded because they have to pay high prices. Well, that's the opposite model, which I call the above replacement cost value or above replacement cost model, which is the development model. So I'll give you an example. So in a downturn at the trough, if you could buy a project that was $80,000 a door and it costs $100,000 to replace, right, below replacement cost, then you would say generally that's, good value, right? And I'm using very simple examples here, but you'll see the point. In a rising or upward trending market, those values for those assets will start to rise, and then eventually they'll flip over, and so the value is now above replacement cost, right? So our model is, build it for 100K a door, and its value when we sell it is 120K, right? So we're the opposite of below replacement cost, and that won't always be true. So when a recession comes, which we're preparing for, anticipating, and not in bad moods about it, just vigilant, preparing, raising capital differently, we'll know that the development model will basically be less preferred when replacement costs can be or projects can be bought below replacement costs. So the market cycle does influence what deals work best. And so we just look at it from the standpoint of we know when that happens. Now, on a long run basis, we know that a recession will come. And what we're anticipating, and one of the reasons we like this workforce housing model, is because our tenant base is very sticky, is the way we describe it. The social networks I described before are very strong. What that means in a recessionary environment, people will stick around. In other words, their families are local, their kids are in school, their church is close by, and so they're not necessarily going to pick up and move to Austin tomorrow. And my internal joke is when you build millennial housing, and this is nothing wrong with the choice that they make, it's just they don't have that stickiness. There's nothing tying them to that market. So they can leave. They got a job in Austin, and they can go and, and they'll leave your apartment if you happen to be renting to that specific profile. So we see workforce housing as a defensive model, meaning we have a stable, sticky tenant base. We know in a recession that values will decline, but if income stays stable, rents stay stable, and NOI stays stable, then as long as our capital doesn't need to get out when the recession is upon us, and we can go beyond that, say 7 to 10 year holds is what we're organizing around now, then we think we have a defensive strategy that's still able to do real estate development.
Okay. No, that's good. I appreciate you elaborating on that. And even the difference in the types of tenants there you were talking about, that's some pretty good information. But you alluded to like the downturn numerous times. And I like to ask most guests that are in your position, how are you preparing for another downturn? What does that look like when you're, especially in the new development, in development model, because that's not something, unfortunately, we get to talk about too often on the show. But I'd love to hear, as far as a new development, how are you preparing for a downturn? What is that? How does that change what you're looking at, or does it, when you're underwriting, you're looking at land and things like that?
Absolutely. Yeah, it's a great question. So our preparation is predominantly revising the financial structure of how we raise equity. So typically when the market is rising and in good shape and we're looking for recession maybe 2 to 4 years out, we would complete a project, lease it up and sell it, right? So build it, rent it, sell it. And that's the merchant build model is what I call that. How we change now is that we're anticipating a recession somewhere between 18 to 36 months out. If you look at the various data points, we don't know that for sure, but we're on the longest expansion that we've had in, recent history. So we just know to be careful and anticipate. So what that has us do is raise equity that is on a 7 to 10 year hold with the idea that we would ride through the recession with our investors, with us and them being patient together, having a defensible, stable tenant base, right? Given these working families want to stay close to their job locations and their families. As long as the income stays stable and we don't have to have a capital event during the recession, meaning investor wants to get out, we got to sell the property and then we're at a loss position because a sale is forced. We want to avoid any sort of forced events because we're in the recession. And so as long as we underwrite our permanent debt appropriately, so we'd be defensive there, meaning assume cushion in the underwriting of the perm loan. Underwrite our rents and NOI and occupancies a little bit more carefully and raise this long-term equity. We can't, of course, guarantee that that will be perfectly bulletproof in a downturn, but compared to most other new development apartments, I'm speaking to specifically, if you're in the millennial market and you have, major job losses in a local market that would hit, say, the technology sector, you could anticipate that a lot of those, folks who are your, profile would leave. They would go home, they'd get roommates, they'd leave town to go get another job. And nothing wrong with that. Those are all perfectly appropriate for their life stage or life, part of their life cycle. We just say we prefer to be in a different demographic that's more defensible. So hopefully that answers the question.
Yeah, no, that's good. But it makes me think of a few more questions there. And I was thinking about if we're expecting a recession, everybody's talking about this downturn, right? And I was thinking about the development model of, buying land, and then there may be, maybe 2 years before this piece of land ever returns any capital, right?
Yep.
And so, how do you prepare for that? Let's, the downturn happens a year into that model, and we're halfway through the construction phase.
Yeah. So in other words,
what does that look like?
Recession hits while you're under construction.
Right.
Right. Okay. So it's a great question. So ostensibly at that point, you've raised all your equity and all your debt to complete. And so you basically first and foremost complete the project, right? In the 2008 recession, we did a lot of capital advisory. So we're advising banks on distressed assets that they had brought into their REO portfolios. And we saw a lot that were half complete. Now, in some cases, the banks actually determined that they would stop funding, which obviously poses a challenge. But if you have your capital structure complete, you finish the deal, then the question becomes, how do you lease the units, right? And you would look forward to potentially a lower than projected rental rate for particular units. And that's where our tenant profile really comes into play, because we're not competing with lots of units that were coming in the supply chain while we were also, right? And so when we come into the market with our workforce housing model, invariably there is no other product type like ours. And I'll tell you why that is. So we build a 5-bedroom, 4-bath, 3-story townhouse rental unit. And that by itself is a complete differentiator in the type of unit that we have when we build it and rent it, and then the type of tenant profile. So what that means is we're not competing with studios and 1-bedrooms, which is the predominant product type for, say, a millennial demographic. Ours is really built and designed to rent and live like a house. Now they're attached. So think row home, 3-story, right? You live above yourself, which is preferable. But we're basically bringing a unit type that is, uncompeted for. I mean, here and there's some projects that, imagine not many people would, take on a 5-bedroom, 4-bath unit. We see this as a key differentiator, what I call a marginal utility, what makes our product different, both for the investor, for us as a sponsor, and then the tenant. And at least in our research, what I alluded to before about these tenants being sticky is that the model, the product type, allows us to be in an uncontested marketplace and have a lot less competition while still having relatively high demand. Now, all those will adjust in a downturn. And so we have other defensive strategies. So as an example, one of the things that we see in these family demographics is in some cases we have Section 8 tenants. And we don't, have a preferential treatment of Section 8 tenants. We just respond to them as they come to lease. But we see that as a great story in a downturn, where we could offer more of those units to Section 8 tenants. And at least in our research, Section 8 is a government subsidized program where the tenant pays 30% of their income and the HUD pays the difference through a housing authority local to where the project is. We see that as a good downturn strategy. The incomes and rents are calculated based on some rolling average rent and income characteristics from, say a year or two before, overlaid with some local comps. And so we're not going to see, at least we don't anticipate, a major drop off in Section 8 rents. And so we can anticipate those to be relatively stable. Again, not perfect, not, bulletproof, but again, defensible. So everything we think of is, can we underwrite a project that's defensible for capital, for the tenant base, for the delivery? Arguably in a downturn, Whitney, if we're halfway through, we might think that we could potentially negotiate some better subcontract rates on construction. We don't rely on that, but we could anticipate that that might be, a conversation to be had at the time. So it's really a function of not saying that we're perfect and bulletproof, but more that we've underwritten conservatively and defensively in a downturn scenario and say, look, if all these things change, here's the way we react to it, and that we've anticipated ahead of time changes and we're not stuck when we get there. That's, I think, the big issue we saw in the '08 recession is people didn't have any other exit strategy. The only exit strategy for a condo project was to build it and sell it. Of course, a lot of condos went to rental market, but the product wasn't necessarily designed and it had a lot of competition. So we're just looking to be defensive at every turn that we can in our underwriting.
Yeah, of course. But I was thinking too about, just the types of investors that are going to invest in a new development versus, a value add type of property, and how would that vary or would it?
Yeah, so great question. So I think of it in this way. I think of the difference as for the categories of how these projects work is 3 buckets, okay? So the first bucket is normal underwriting of rents and operating expenses. We all have to look at rents, look at the market, underwrite the tenant base, the capability to, compete in the marketplace appropriately, raise rents if we can, if we're value add, and achieve the rents, purely and simply if we have a new unit, right? Operating expense assessments, we have the right property manager, are they managing appropriately? For us, we use historics for new construction apartments overlaid with advisory from property managers that we work with. But still, the formulas and the assessments of the market of those costs and incomes are the same. We want to generate NOI, the highest possible NOI. So that's exactly the same. Product's a little bit different. How you use comparable a little bit different. The second bucket is what I call the development bucket. And that's where we get into things like, assessing land assets, zoning, those kind of design issues that you're creating projects from basically nothing, right? You have to, you have to create the model. You have to create the programming. Versus in a value add space, you basically have projects that are for sale in the marketplace that either fit your criteria or you don't, but you can't create, a whole project of 5 bedrooms, right? Or rather, you can't buy one that has that. If that was your criteria to purchase, you would, have it because you bought it from us, I suppose. But basically, that's the development model. And then the third part is, which is the most important part for all of us, is how do you exit? How do we underwrite our exit? What's our exit cap rate? How will the market respond to the project when we sell it? And that's the same for value add and new construction, right? The formulas and the way that we go about selling these, maximizing value is common between those two. So when I tell people about this 3-bucket system, I point to the second bucket and I say, there's your big difference. In other words, if you're only a value add investor and now you need to get into the development space or you want to, you need to be very watchful for the zoning, land assessment, construction, like a new construction model. And that's where we see, sort of the major differences between those two.
Nice. So, can you tell us maybe something that, on a recent project that maybe didn't go as planned and how you turned that around?
Yeah. This is in bucket 2 for the development business. This is one of those things that we have a lot more government oversight on our projects. So what I mean by that is, if we do have to zone, which we generally don't, like a rezone or entitlement process, we avoid that. But then we have a full-scale set of CDs, and we have to go through plan check. Where in a value add project, if you're changing, paint, carpet, cabinets, and those kind of things, and maybe avoiding systems, you don't really have to deal with the inspectors a little bit, but not as much as we do. We're much more in depth in that. And so what we find is in that space, we're thwarted on the project schedules, regularly by government, bureaucracy. Governments don't care that our projects need to be done in, 12 months or 18 months. They're indifferent to that. So that's always a challenge. But, a recent project we had, and actually in my hometown of Long Beach, we ended up, we were going through our final inspection cycle, And we ended up having numerous inspectors that were brand new. They had literally been hired by the city in the few weeks or a couple months before. And what
Perfect timing.
Yeah, new inspectors are like, they're scared of their own shadow. I mean, they're all good folks, but they're by the book. I had one inspector who sat down and read the installation manual for our tankless hot water heaters, and figured out that we had installed them, 1 inch too close to, some other, I think it was a window, and they have to be separated a certain amount. We ended up basically showing him the measurements that he was off. But, here's a guy who spent 20 minutes, I think, sort of looking for something to tag us for. And we had, I swear, the hardest time. In fact, tomorrow will be our final inspection, our last inspection, then we'll be able to be complete and sell that project once we TCO. So that would be a typical one. We saw a lot of deals during the downturn that were projects that were good projects, but for the delay in the completion of your construction cycle, you would have avoided or not the recession. So if you'd finished in a year instead of 18 months or 24 months, we saw a lot of the distressed asset advisory projects that we had that just ended up going, 3 years of construction for a major, like a mid-sized project should have been done faster. And so on our website, on our blog, I wrote an article about how to prepare for a recession as an investor. And one of the tenets I put in there is watch your construction cycle as you get near a recession and plan for contingencies if you get delayed. Like a delay could push you into the recession. And then we get into those defensive strategies that we talked about before. But the first thing to do is not be delayed. So that's a common, and I think that's true of every construction project. So I'm not, there's nothing special about that, but it needs to be managed nonetheless. And, picking good subs and having good staff in-house, and maybe even picking the right cities that are friendly to work with help all that.
If you could look back, I don't know, 10, 20 years, however long, or maybe there's somebody listening that says, I'm really looking to get into new development, or maybe yourself many years ago, what in just a couple, 3 sentences, what would you say, what would be your best advice for them?
Yeah, that's actually a great question. In fact, I wrote an article called 6 Ways to Build Your Real Estate Development Career. It was very specific. And the one that I would say is weighted most heavily is either joint venture with other developers who are more seasoned and senior than you, say you're a beginning developer, and learn from them. Even go into a deal knowing that, hey, look, I may not make as much money as I prefer. Everybody's got to generate income, so that doesn't stop. But you may trade learning to be in a deal, maybe take a smaller share, but say, hey, I want to be shoulder to shoulder with you, Mr. Developer, or, shadow you. Or you get a mentor, somebody who's in the business, or the third option is you hire an advisor. I mean, I know people who are in my networks that are, retired real estate developers that are available in essence, on a consulting fee basis. And, fundamentally it's get good help. And I mean help in the sense of, acknowledge that you're a beginner in the space and that you need to learn first and foremost the very technical characteristics that you deal with in the development space that are much different. So that second bucket idea of zoning and construction management, design management, that kind of thing. I see too many, I'm on Bigger Pockets a lot, right? And I see a lot of people who want to get into that space and they just launch and they have nobody around them in their networks who's more skilled in that space. And, they're asking me, hey, what do I do? I found a deal and I want to build 30 apartment units and gosh, where do I start? And, I understand they're beginners and they're asking for advice. I always tell them, go get a mentor, go get an advisor, partner with somebody. Don't do it yourself. Don't be a lone ranger. Some people take the advice, some don't. But this business is so technical and obscure. I mean, just the idea of zoning and understanding zoning is so not normal and uncommon in just everyday life that it takes a lot to learn it, and it's very idiosyncratic, right? This city does this and another city does this completely the opposite. And if you didn't know that, you might, run afoul of some regulation or rule that would, hurt your project. So.
Definitely money well spent. I know the listeners heard that so many times on the show from me, and probably well over 100 different guests, that have said, get a mentor as somebody that, advisor, just like you said, it's going to be definitely money well spent.
It's totally worth it. I have people who approach me all the time and say, hey, I want to be an intern, or, I want you to be my mentor. And so a lot of times what I'll do is I'll say, come work for free. Of course, everybody's like, no way, I don't want to work for free. And I go, I will teach you. In fact, I have a guy who works for me now. He's an assistant project manager that basically did that. And he's now in a paid position. But I encourage people, make that trade, right? Approach somebody, a developer who may not give you the time of day, but if you say, hey, look, I'm going to give you 20 hours a week for free. I will do whatever you want. I'll go fetch coffee, whatever. I'll run around. It will be so worth it, the amount of investment that you make by not getting paid, right?
I agree. I bet I get 3 calls a week about this exact same thing. And right. I'm so glad that you brought that up, because I tell all of them, like, especially if they're not married, no kids, they're 19, 21, whatever, I say, you find a mentor and you offer to work for free. You go work somewhere else part-time just to survive. Yeah. But after 1 year of doing that, you are going to be so much further ahead than the majority of people that are trying to get started.
Absolutely.
It's just incredible where you would be.
And even, like I had a boss, I used to work for a division of what is now KB Home, doing apartment development as a corporate offer for them. And my boss, a guy named Mike Costa, a really good guy, I keep in touch with him now. We were debating, hey, should I go get a master's degree, master's of real estate development? USC has a program in that. He's like, no, don't. Spend a year with me, spend 2 years with me, and I will teach you more than you will ever be able to learn in the classroom. And this is one of those. And I think real estate deals, real estate syndication, investment, development all have similar characteristics. Is you just hard to learn it best from a book. And, there's lots of good authors. I have a full library of all the great syndication books, probably the same as you do, but nothing like going out and doing it and getting the help, mentor, or JV it deal basically takes particularly the JV, it takes the financial pressure and risk off of you as a beginner. And so you can make those mistakes and not have it absolutely, just shatter your deal. Like,
right.
Where somebody went in, made a fundamental error, and we never wish it, but their deal died, or they didn't make money, or they're even in a loss position. And so had they traded away 50 or 75% of their back end to invite somebody who's highly skilled, they probably made more money doing that, much less learning that they got along the way. So all beginners should do that.
All right, a couple questions before we have to go, because we're pushing the time limit.
Sure.
But Scott, what's a way that you've recently improved your business that we could all apply to ours?
So a couple quick answers. One is I'm very focused on creating standard operating procedures in the development business. Research and due diligence on a site would be an example. I'm writing standard operating procedures, documenting them. I'm requiring my staff to do so that we can have a standardized system of, methodologies and steps to go through on a project. And particularly, I do that because, and this is true in any real estate endeavor, there's so many details to track that if you don't create a SOP, standard operating procedure, a checklist, you're gonna miss something. I'm a checklist, proponent, big time, but checklists don't describe how to do something to somebody who doesn't necessarily know how to do it. And I'm talking, low and mid-level tasks. The really high-level tasks sometimes can be put in SOP, sometimes they can't. The other one I would say, which is a big, part of our effort right now, is basically creating social media content and getting out in the marketplace with the story of what we're doing as a developer, and people who are raising capital on their own deals could do the same thing. I think on a go-forward basis, all developers, investors, sponsors in the real estate business need to be in that social media space, because that's the only way, in many cases, anybody's going to find you, right? You have a podcast,
right.
You're certainly doing this right now. Gary Vaynerchuk, Gary V, everybody knows, he says every company now is a content company or a media company. Whether you're in the real estate business or any product business, you need to be a media company first. then, you got to execute well on your main business. But I thought that was telling.
For sure. How do you document all your SOP quickly? Are you using like some type of program, or is it all by hand?
We're just basically, it's a combination of, we use a web platform, project management platform called Monday.com.
Mm-hmm.
And we start the SOPs there, and then they translate into basically a written document. Even something as simple as a Word document that has a table of contents with links that hyperlink to the section. So you can go in and say, hey, I want to research zoning. How do I do that? Click the link, and then there's the steps to go through to complete that process.
What's the number one thing that's contributed to your success?
Tenacity. Real estate is a tough business. We all go through, hard times in deals and getting thwarted and not having it go how you want, taking longer. And I think the ability to just sustain, I love real estate and real estate development so much, Whitney, that it carries me through the times where I'm getting beat up in a deal, which, happens to everybody. And I don't mean like a deal lost, just, the inspector doesn't want to pass my inspection, or, pricing for construction is going up continuously. These are just things that we experience. We don't control them, right? It's the marketplace speaking in its way. And so you have to, have the tenacity and the love and the passion to be able to sustain those hard times to get back to the good times.
Nice. And before we have to go, tell the listeners how you like to give back.
So we actually do. So I'm such a real estate development, this is my passion, that where I give back is in that space. And so we regularly advise nonprofits that are needing real estate, say they need to buy a building or they are looking to build a building. So recently, in the last few years, we consulted for a arts nonprofit in Long Beach called Art Exchange, and they were looking to buy a headquarters building. So we came in and helped them for a few months to basically just make assessments of the building, to underwrite. So basically being a real estate developer, but for free, pro bono, on behalf of a nonprofit or somebody who's looking to produce a real estate project without the expertise.
That's awesome. That's a great way to give back and use your skills in a great way. Thanks for sharing that.
But that.
Before we go, the very last thing, tell the listeners how they can get in touch with you.
So I would encourage people to go to our website, which is www.urbanpacific.com. That's URBAN Pacific, like the ocean.com. And there's a sign up button to sign up for a weekly newsletter, as well as we have our active investment projects on there. And then, of course, there's a contact button at the bottom of the landing page. And, people can send us an email through that. And our social media team gets those and forwards them to me as appropriate.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.